Good morning. Let me welcome everyone in the room and everyone online to the annual Monetary Policy Conference. So this has a fairly fixed title, Bridging Science and Practice, and that's what I hope over the next day and a half. There will be many opportunities, hopefully, for the exchanges in both directions, from practitioners like me towards the more researchers and vice versa. So I think this is a very successful series, and I think the next couple of days, I'm sure we'll maintain that tradition. So what I want to do this morning is to talk about how we actually do monetary policy, how we conduct monetary policy. And the context for this is really we have an updated monetary policy strategy that we finished in June this year. And I'm going to go through some of there's a lot in that, but I'm going to go through the elements that are most directly relevant for how we make decisions on a meeting-by-meeting basis. After that, so that's a strategic overview. Then I will move to the current inflation outlook, and let me make a few comments about the current inflation outlook. And then I'll come back and say, okay, having given you this strategic framing, how do I make that operational in the context of where we are today? So those are the three elements, of the speech today. So maybe if we go to the first slide. And here I'm going to jump around. I think it makes sense like this. And again, when someone reads these strategy statements, you might say, that's obvious. At some level, it's obvious, but it's still worth a little bit of time to reflect upon. So in this paragraph, the ECB Governing Council says, we're aiming for 2% inflation. You've probably heard that number before. We also say over the medium term. So it's not saying we want to deliver 2%, every month, but it's over the medium term. I'll come back to that point. And then the second element of this paragraph is the symmetry, which means that negative and positive deviations from the target are equally undesirable. So, of course, in many models, this is built in. There might be a quadratic loss function, which is built-in symmetry around a target. And one of the reasons why we have a point target is it provides a clear anchor for inflation expectations. We want everyone, households, firms, market participants, to have 2-0, imprinted in their brain. And of course, once you think about that clarity would not be delivered if we had a zonal inflation target. So, of course, you can always think about having a zone. But then if we had a zonal inflation target, any number between an upper band and lower band is okay. Then it's going to be putting people to work. Market participants, households and firms would have to continually reassess what part of the zone are they really focused on right now. And so the clarity of having a point target is important. So if we go to the next slide. So, okay, we do have this important qualification or consideration, which is over the medium term. So what does this mean? It means that we know there's going to be short-term deviations. That's inevitable. We also know, because of the lags and the uncertainty in the transmission of monetary policy, there's a limit to what you want to do in terms of chasing near-term fluctuations. So does the medium term mean a fixed horizon? Does it mean a year from now? Does it mean 2 years from now? Well, here, I think what we've come up with, I think, is reasonable. It has to be a flexible concept, which takes into account that the appropriate monetary policy response, and in the end, that's what we're trying to get to. What is the appropriate monetary policy response? It's context-specific and depends on the origin, magnitude, and persistence of the deviation from the target. And subject to maintaining anchored expectations, it also allows us to take into account other considerations relevant to the pursuit of price stability. So let me elaborate on that a little bit. In terms of origin, I suppose the classic distinction is between demand-type shocks that move inflation and real activity in the same direction, versus supply shocks, which might move them in opposite directions and thereby create a temporary trade-off. And with the medium-term orientation, it provides us the flexibility to look through temporary shocks that might dissipate on their own accord and therefore avoid unnecessary volatility in activity and employment. So that's the origin. Pretty basically, you can do it more elaborately, but a pretty basic distinction as far as you can go between demand-type shocks and supply-type shocks, even if that's not a perfect decomposition. Now, in terms of magnitude and persistence, you can think about this in many ways, but I think it should be consensual that a small transitory shock poses less risk to the anchoring of expectations than a larger, more persistent shock. And again, you may say, okay, that's obvious, but of course there's a judgment call about how large is large and how persistent is persistent. So let me turn to the next slide. And you might say, this is the most obvious thing you've said so far. But actually, let me say this has content. So we've said we're aiming for 2% in the medium term. I can aim for lots of things. This paragraph is a commitment. It says we're actually going to use our monetary policy to deliver that. And again, that is consequential in terms of accountability, in terms of how we justify our monetary policy decisions. We have to be able to justify them in line with this commitment, which is to deliver the 2% target over the medium term. So what does that mean? It means we're an inflation targeter. So, many of you here would have studied inflation targeting type monetary policy. And this is the conversion, the transition from having an aim of 2% to actually organising your monetary policy around that point, while of course maintaining the flexibility of the medium-term concept. So if I turn to the next part of it, and in paragraph 9, we said, okay, we're going to deliver 2% medium term. Now let's convert that into a playbook. And the playbook is we will base our decisions, including the evaluation of proportionality and potential side effects, on an integrated assessment of all relevant factors. This is actually something we decided in the 21 review. And if you remember, for those of you who have longer memories, these be kind of side-by-side type assessments at the ECB, where there would be an economic assessment and then a separate monetary assessment. Now we have an integrated assessment of all relevant factors. But the next sentence is new in 2025. It says we will take into account not only the most likely path for inflation and the economy, so the baseline, for example, in the staff projections, is the staff view of the most likely path, but also the surrounding risks and uncertainty, including through the appropriate use of scenario and sensitivity analyses. And again, this sounds straightforward. I think you would assume that we are risk managers, we take into account risk. And of course, that's always been true. But it's important to articulate that, because maybe there has been a temptation in some quarters from people looking at ECB to have a kind of simple-minded mapping, saying, okay, here's their baseline, therefore here's their monetary policy decision. And of course, the baseline remains super important, but we also have to take into account risk and uncertainty. And this, we do think, is right now for the rest of this decade, because this strategy is built until 2030. It's focused on the next 5 years. And in the next 5 years, paragraph 1 of the statement. If you go to the next slide. Basically, there's a big economic exercise. You can read the staff vocational paper which goes through it, which does conclude that essentially all of these structural shifts that kind of dominate discussion on a day-by-day basis. So whether that's geopolitics, digitalization, artificial intelligence, demography, the threat to environmental sustainability, and changes in the international financial system. So there's a lot of structural trends out there. Means that we think it means inflation is going to be more uncertain and potentially more volatile. And importantly, this does not necessarily change the average inflation rate. We could have larger target deviations in either direction. And if we have this world where essentially it's not that stable, working through how to incorporate risk and uncertainty is not the same as in a very stable world where you have very stable relations in the economy, and you can rely on the impulse response functions based on historical data to guide you. So the idea that we're kind of stepping up the analysis of risk and uncertainty is motivated by the environment we think we're going to be in. Okay, let me turn to an important element of the strategy in paragraph 6. So we've just come through a really big inflation shock. Before the pandemic, we had very long-lasting deviations, downward deviations from the target, where we brought rates to minus 0.5 and lots of other policies. And so what we say here is we recognize if there's a large sustained deviation of inflation from the target in either direction, so either being well below target and requiring us to respond to that, or being well above target as it was in 2021-22, we have to be appropriately forceful or persistent in response to that. So in one direction, in relation to the downside, we need to take into account the effect of lower bound. In the other direction, I think what we learned from the most recent episode is we need to take into account possible non-linearities in price and wage setting. So in other words, when you have these large deviations from target, you basically press the red button and you go into this forceful or persistent response mode. So let me, of course, note here, there's a clear difference between, if you like, standard phases in which inflation may fluctuate, but not to the extent of a large or sustained deviation from target. And then this type of acute phase, this kind of crisis phase I've just talked about. So we have some straightforward cases. Large and sustained, okay, we have a playbook. Small and transitory, we can discount. So then we have this intermediate zone where the inflation deviations neither small and transitory nor large and sustained. And in that intermediate zone, that's, I think, where most of the monetary policy papers have been written on. Most of the textbooks are focused on essentially more or less a linear shock, a shock that moves you away from the equilibrium, but doesn't move you into some big non-linear zone. And we have a lot of analysis about that, but it does require a lot of judgment. But let me mention that this really is a zone where a lot of hard work is needed, because I hope the frequency of large and sustained deviations of inflation from target should be quite rare. I think in the absence of really extraordinary constellations of shocks, and I think the pandemic and Russia's unjustified invasion of Ukraine provided that extraordinary constellation of shocks, the main reason why we might get a large and sustained deviation of inflation from target would be a failure in monetary policy. Because if we don't respond sufficiently to those intermediate cyclical type shocks, we may foster an incremental cumulative drift away from the target that then de-anchors expectations. And you do get that large and sustained deviation, which once we have it, of course, the red button gets pressed. But I think it's better to avoid it in the first place. Coming back to the reminder, most of monetary policy should be dealing with that kind of intermediate level deviation. Okay, let me now turn to the current inflation outlook. And later on, I'll come to the risk assessment. So I'm going to focus on the September projections. Some people may want me to comment on the most recent movements in the data, this morning's oil price or whatever. But essentially, the discipline of using the macroeconomic projections and using our intermediate policy meetings to update in a kind of coherent way rather than kind of providing a commentary every day is probably a good idea. So I'm going to focus on the September baseline. So maybe I'll come to that in a second. So before I come to non-energy inflation, overall inflation is projected at 2.1 this year, 1.7 next year, and 1.9 in 27. So how do we think about those type of numbers? Because, of course, they are close to 2%. So compared to the previous years, so in 21, we were at 2.6, 22, 8.4, 23, 5.4, and then 2024, 2.4. All of these numbers are much closer to target. So the kind of excitement and trauma of those high inflation years, we're not in that zone. So the question is, are we in that intermediate zone where these are deviations which are big enough and persistent enough that we need to think about them? So for this reason, one way to think about it is indeed to differentiate between energy inflation and non-energy inflation. So here, my first chart is non-energy inflation. This is the aggregate of food, goods and services inflation. And the reason to have this differentiation is energy inflation, I'm going to show you, has quite a different profile. Traditionally, food inflation is also kept to one side. It's not so clear that sometimes there are food shocks, and there are food shocks, commodity price shocks. But in the end, food is such a big part of the overall inflation dynamic. It's useful to look at this aggregate. So if you look at this chart here, what you see, and this is quarterly data. I'm going to call out annual numbers in a second. The quarterly data have a slightly different profile. But what we have is under the baseline, non-energy inflation this year is still at 2.5. So non-energy inflation is still well above target. We have 2% in 26 and 1.9 in 27. So the dotted line is the projection. So we do have a bit more disinflation to come. The projection is we go from 2.5 this year to 2.0 next year. Now, if I go to the next chart, what you see here is that disinflation applies both to food disinflation and services disinflation. So what we have here is food inflation falling from, because this year there's been a lot of writing about food inflation. This year it's still at 2.9, so still quite high this year. But dropping to 2.3 in 26 and remain at 2.3 in 27. So again, for those many people saying, oh, what about food inflation? The staff projections have a big drop between this year and next year. Same for services inflation. So services inflation is still high this year at 3.4, dropping to 2.7 next year and 2.3 in 27. So there's another leg of disinflation in services inflation projected. On the other hand, goods inflation, in fact, is relatively flat. It's already 0.6 this year, 0.4 next year, and 0.8 in 27. So in the grand scheme, goods inflation has gone back to the historical norm of being pretty flat, maybe to do with globalization and technical change. So you might say, well, where is that projection coming from? Where is that disinflation in food and services inflation coming from? Well, it's backed up basically by the deceleration in wages. So the staff projection has compensation per employee. The growth rate coming down from 3.4 this year to 2.7 both in 26 and 27. So we still have a final step, if you like, of wage deceleration to come. And that's cross-validated by the different surveys and by the ECB wage tracker. And again, first and foremost in this, and I'm looking at Olivier here because this is very consistent with the Bernanke-Blanchard setup, it is essentially the real wage gap, which has been driving nominal wage growth in recent years, has largely closed. So there was nominal wages were growing more quickly than normal in order to rebuild the real wages that fell quite a bit during the peak inflation period. Other factors contributing to this further disinflation next year is the euro appreciation. The spillover from ongoing energy deflation, I'll come to that in a minute, and the deflationary impact of lower export prices from China. There's also a straightforward fiscal element, which is both in 24-25, many governments have been reversing the fiscal subsidies they brought in 22-23. So those fiscal subsidies were brought in to mitigate the surge in the cost of living in 22-23. And that kind of payback in 24-25 is washing out to the data more or less next year. And of course, the disinflation also relates to the past phase of a restrictive monetary policy, where by pushing up interest rates, we moderated domestic demand, putting down the pressure on wage growth and profit growth. So what we have now is a transition where next year and the year after, we expect non-energy inflation to stabilise around 2%. And that transition from disinflation every year to stabilisation around the target, of course, has been supported by the switch in our monetary policy from being restrictive to reducing the policy rate by 200 basis points in the last 15 months. And of course, it's a projection that is built on assuming that we deliver a target consistent monetary policy in the coming months. So it's a policy conditional projection. So you might say all of that is interesting, but in the end, I care about overall inflation. And you might say, I thought overall inflation is around a target. And you've just said that in 2025, non-energy inflation remains at 2.5. So the reconciliation is, if you go to the next slide, it is the profile of energy inflation. And we have energy inflation this year at minus 1.6. So overall inflation being at 2.1 is non-energy at 2.5 and energy at minus 1.6. And it adds up to 2.1 on average. Next year, we still have energy deflation, less so, but still deflation. So we have minus 1.1 next year. So we have lower non-energy inflation, but less energy deflation than this year. And then we have a sizable turnaround. We have a 3.5 percentage point jump in energy inflation 27, from minus 1.1 in 26 to plus 2.4 in 27. And in part that's related to a policy move. the scheduled introduction of the Emissions Trading System 2, ETS 2, which should have a one-off impact on the energy price level. So maybe it's worth thinking about, where do we think energy inflation is going? And I think we have to think about this in the context of the profile here. Because the profile here said, well, in the first year of the pandemic, with global demand quite low, we had energy disinflation. It was negative inflation of minus 6.8 in 2020. But then the energy inflation rate went to 13 in 21 and 37 in 22. This is a really big increase in the relative price of energy. And then what we've had since then is mild deflation. So mild energy inflation, minus 2 in 23, minus 2.2 in 24, and then minus 1s this year and next year. So the question is, where do we go next? So that jump in energy inflation in 27, is that the end of the energy deflation period? Or is it just a one-time deviation due to the policy change? And in particular, how much weight should we give to an error correction process by which that big jump in the relative price of energy in 21-22 operates as a negative drag on energy inflation in the coming years? So again, if you think to some underlying trend line, which is going to suck the energy inflation rate back to this trend line, then the energy deflation may have more to play out. But of course, here there's a big political economy set of issues about the future of energy inflation, given the competing political forces. And the reason why I dwell on this is not just because energy is part of the overall inflation rate, but the spillover. What we learned from these years is if there's not for tiny blips, but if there's a material movement in energy inflation, that spills over to non-energy inflation, to the price of food, the price of goods, and to the price of services. And I'll come back to that a little bit in the next section when I talk about the risk assessment. Okay, so now I'm in the third phase of the talk, where I look at the near-term conduct of monetary policy. So with this setup, where we're trying to not only look at the baseline, but also to look at the risk assessment, and then when the staff look at the research literature, and I look at the research literature, how do you strike the balance between the baseline and the risk assessment? It is not straightforward. And this is why I think we will maintain a very good monetary policy group who will help us think through that assessment. And in particular, there is a big literature about monetary policy under uncertainty, but it's a highly nuanced set of results, and there's no universal message. So in particular, it really is context specific about whether the presence of risk means you should wait and see, or alternatively, it means you should respond immediately for insurance-type risk management considerations. So every time, is the risk assessment saying, okay, let's wait and see, let's see how this plays out over time, or the risk assessment says, we really need to move now because the cost of delay exceeds the cost of moving now, even under uncertainty. And then the second part of that is, let's say you do decide to move the policy rate. Does the presence of risk mean you attenuate the size of the move? Or do you amplify it? Do you scale up in order to manage the risk? So again, the frequency of rate moves and the size of rate moves really are context specific. And where does that get me? It means, believe it or not, in the coming weeks and months, the context-specific nature means we need to be data-dependent and go meeting by meeting. And no pre-commitment to any particular rate path. So coming back to our strategy, we will have to assess the inflation outlook, the most likely path, and the surrounding risks in light of the incoming economic and financial data. And we have a system where that kind of forward-looking assessment of the inflation outlook is cross-checked with the assessment of the dynamics of underlying inflation. And also, of course, to calibrate monetary policy, you want to know how strong is the monetary policy transmission mechanism, which compared to the average can sometimes be stronger, sometimes weaker. The incoming data will mean basically updates to the baseline, but will also matter for the risk distribution. So if there's an increase in the likelihood or intensity of downside risks, it means that a slightly lower policy rate might better protect the medium-term inflation target. Alternatively, an increase in the likelihood or intensity of upside risk factors would suggest that maintaining the current policy rate would be appropriate in the near term. In terms of thinking about possible increases in the policy rate, I don't think the current risk distribution indicates that that's essentially a live possibility in the near term. But of course, over a longer horizon, the policy rate has two-sided risk. So what are the downside risks we're currently focused on? So in the September monetary policy statement, the downside risks included a stronger euro, number one. Number two, the risk that higher tariffs could lead to lower demand for euro area exports. So we could see a slowdown from that point of view. And also higher tariffs globally could induce countries with overcapacity to further increase their exports to the euro area. We could also see that trade tensions could lead to greater volatility and risk aversion in financial markets, which would weigh on domestic demand and thereby also lower inflation. In terms of upside risks for inflation, we list the risk that if we saw a fragmentation of global supply chains, that could push up import prices and add to capacity constraints in the domestic economy. We also recognise that if there were a boost in defence and infrastructure spending beyond what's already assumed in the baseline, that could raise inflation over the medium term. And going back to volatility, we also recognise that extreme weather events and the unfolding climate crisis more broadly could drive up food prices more than expected. So those are the list of factors. And again, essentially, the team here, but I would hope the external world is continually looking at the likelihood and the intensity of those risk factors. In addition to that kind of very specific inflation risk assessment, we have a broader economic activity risk assessment, given the relationship between economic slack and medium-term inflation pressures, and also, which is especially true when inflation is close to target, and of course with the caveat of subject to maintaining anchored inflation expectations, the flexibility of our medium-term orientation does mean if we saw a significant movement in the risk to economic activity, that's also relevant for the monetary policy meeting decision, since the medium-term flexibility allows us to cater for other considerations relevant to the pursuit of price stability. So in relation to economic activity, in September we said that risks to economic growth have become more balanced. This was after having flagged that the balance was to the downside. And I think it's clear, given the very high uncertainty we had in May, June, before the new tariff policy was in place, there were more severe downside risks being entertained. We still have downside risk scenarios, as I've listed, but less severe than might have been entertained in that time period. So while recent trade agreements have reduced uncertainty somewhat, we also think the overall impact of the change in the global policy environment will take time to clarify. And if we did see a new cycle of a worsening of trade relations And again, every trading relation in the world, not just the EU ones, would matter for this. It could dampen exports and drag down investment and consumption. And again, if we saw a decline in financial market sentiment around the world, that could lead to tighter financing conditions, greater risk aversion, and weaker growth. And of course, we have the geopolitical tensions, such as Russia's unjustified war against Ukraine and the tragic conflict in the Middle East, which remains a major source of uncertainty. We do have upside risks as well to the baseline growth path, higher than expected fiscal expansion, more supply-side reforms in the EU area, animal spirits and improvement in business confidence, all of that could help. It would also be helped if the remaining trade disputes were resolved faster than expected, or if geopolitical tensions diminished. Now, you might say that's a lot of different scenarios. So let me come back to two basic mechanisms that cut across a lot of those scenarios. Number one is energy prices. You can think about a lot of those scenarios maybe showing up most immediately in terms of the energy market. And this goes back to, again, what are the, if you look at the history of the euro, what causes inflation to really move away from the target? And thinking about the energy price dynamics behind that. And as I indicated, if you do get a big energy price shock, it tends to spill over to the other categories. At the same time, it's also important to recognize that the impact of energy inflation on overall inflation is state dependent. It's going to be lower under subdued demand conditions compared to than if demand were buoyant. And again, 2022, when the European economy reopened after the pandemic, the impact of energy prices when there's pretty strong recovery in demand is clearly not a guide to what might happen if there were a surge of energy prices at a time when demand conditions were weaker. And to repeat, it's also, I think, lurking behind the whole energy price dynamic is whether we're going to see an error correction mechanism where this big jump in the relative price of energy in 21-22 will return to trend over time. In relation to the exchange rate, because we've seen the exchange rate move quite a bit this year, the exchange rate, again, if you look at the history of the euro, big movements in exchange rates have mattered for the European economy, for activity levels and for inflation. And, there's a lot of work on that. But again, it's clear that the impact will be larger than the time series average. We have average elasticities, if you like. The effect would be larger if the euro appreciations due to external factors. So you can have the euro appreciate if our main trading partners are weak. Or there's a portfolio rebalancing towards the euro, which is more due to an increase in the risk premium elsewhere. These cause euro appreciation, but they don't raise demand for euro area products. In the direction, we'll have a smaller effect if the euro appreciation is due to a surge in domestic demand. So firms will maintain prices rather than cut prices if demand is strong, or if the euro appreciation is due to a re-rating of the domestic risk premium. So if basically the world wants to finance European firms at a cheaper rate, that's going to be a strengthening of the European economy at the same time as euro appreciation. So the co-movement between the euro and these other factors are very important. In exchange rate economics, quite often what people look at is the difference. So the difference between demand overseas and demand at home, the difference between the foreign risk premium and the domestic risk premium. But I think it makes a big difference whether that differential is moving because the foreign element is moving or the domestic element is moving. And in particular, the pricing power of domestic firms would be lower if it's basically a weak scenario, so that euro appreciation induces firms to cut prices to protect market share, than in the latter case, such that euro appreciation might just be taken as extra profits. Let me, before I finish, just make a side comment here. I haven't said too much about the strength of monetary transmission, even though that's a core part of how we make monetary policy decisions. And that's basically in order to persuade you to come back in a couple of weeks to our next conference, when I'll have a dedicated speech about monetary policy transmission. So let me say, you've emphasised quite a bit here the staff projections, which come every quarter. I really appreciate and value the staff projections. They've provided a very good guide, actually, in the last couple of years. The forecast errors have been relatively small. So even at the peak of inflation in the end of 22, if you go back to December 22 to the staff projections then, they had a very strong disinflation and projected, which I think was a very good guide. But let me emphasize, at the in-between meetings, the staff make sure we have lots of data to analyse at the non-forecast meetings. So at the non-forecast meetings, including the one in Florence at the end of October, we'll have the really rich corporate telephone survey, which tells us what's on the minds of non-financial corporates. We'll have the well-established bank lending survey. We'll have the expanded now quarterly survey on access to finance to SAFE. We'll have the consumer expectation survey, which many people look at the inflation expectation, but it's a much broader survey with many elements of household behaviour covered in that. We'll have the survey of professional forecasters and also the survey of monetary analysts. So we'll have a very rich set of data, which may be interesting from the point of view of monetary policy. Is most of that will be private to the ECB until some of it comes out right before the meeting, like the bank lending survey comes out the day before. Others we release after the meeting. But from the point of view of having maybe an asymmetry with the market, all of those surveys create some type of asymmetry. So with all of that, I think my attitude is we need to remain open-minded. That we need to really be rigorous in how we incorporate the incoming information. Again, not only to update the baseline, but also to have this updating of the risk assessment. So let me finish by lining up with what President Lagarde said at the Bank of Finland last week, which is we cannot pre-commit to any future rate path, whether one of action or inaction. We must remain agile and ready to respond to the data as they come in.